Throughout the first 3 quarters of 2014, we talked a lot about the U.S. apartment market outperforming expectations, both from within the industry and from Wall Street. Did that momentum carry through the fourth quarter of 2014? That's our topic for today. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett. And Greg, heading into fourth quarter, we talked a lot about the potential vulnerability in Q4 given the big wave of supply coming online, plus the fact that Q4 is seasonally a pretty weak period for demand. So what happened? Well, we continue to exceed expectations for the most part, with some strong rent growth numbers and decent numbers in occupancy and demand. So Greg, why don't you get us started with some of these highlights?
Certainly, the headline story for the quarter is what happened with rent growth, and these are some impressive numbers. Now, usually fourth quarter is a weak period, as Jay said. You tend to have flat to slightly declining rents, and in 2014, during fourth quarter, we had effective rent growth for new leases of 0.6% across the nation's top 100 markets, and given that's a pretty solid positive number, and you look at the annual calculations, we're removing a slight negative number from 2013. This annual number moved a lot. The year-over-year rent change for calendar 2014 is 4.7%.
So Greg, we're now 5 years into this market cycle. And at this point in the cycle, I'm pretty sure no one expected it would be at 4.7% for the U.S. apartment market in terms of year-on-year rent growth. So that's got to be a pretty impressive number for this stage.
It is an impressive number for this stage. And what you normally see as you go through the cycle, you get your strongest rent growth during the first couple of years of the cycle. Then completions start to ramp up just at the same time that job growth is tending to taper off a little bit. But what we saw this time is that we have the completion number and the job gain number peaking at the same time. So that is a really solid position to be in there. And really, 5 years into it, this rent growth that's really back in line with the peak number we saw in 2011. That is just a signal of the legs that we're going to see in this cycle. We've been saying it's going to be the longest period of sustained, solid performance for the apartment market that's ever occurred, and that we're certainly on track to see that continue.
So great rent growth, and that's been fueled obviously in part by some solid occupancy rates and strong demand of late. Let's take a look at those numbers now. The numbers are good for Q4, but maybe not quite as strong as the rent growth we saw. Q4 2014 occupancy came in at 95.3%. That was up 30 basis points year over year. For the quarter, it was down 50 basis points. And to some degree, that dip reflected some normal seasonality. As we mentioned earlier, demand is just seasonally weaker in the winter months. But even taking seasonality into consideration, lease-up rates weakened for these new projects coming online. And again, part of that has to do with the fact that we just had so much completing in the last 3 months of 2014. So that means we're going to start 2015 with a good bit of new products still going through the lease-up stage. But on the positive side, for 2014 overall, we didn't see lease-up sap as much demand from existing product as had been expected. And let's dig into the supply and demand numbers, see how we got to that occupancy number. Completions during Q4 came in at 69,246 units. Now, some continuing construction delays held deliveries below the 90,000 plus mark that had originally been scheduled to finish, but it's still, even with those delays, still a very hefty number to complete in Q4. At the same time, quarterly demand was negative, down 7,886 units. It's important to view that number from some appropriate perspective here, which we need to give a little bit of context. From 2010 to 2013, which was a period of robust apartment demand overall, the Q4 norm was net move-outs from about 20,000 units. So demand of -7 to -8,000 in late 2014 is a bit better than that seasonal average. And we completed for the overall in 2014, we completed 246,579 units, and that's the stat for the 100 biggest metros across the country. And at the same time, demand was moderately better than that, 268,532 units.
Jay, let's look at those construction figures and what are we going to see delivered next year. And really, the completion number should look pretty similar to the 2014 figure. We have 405,886 units under construction in the top 100 metros right now. And of those, 290,145 units are scheduled to finish during calendar 2015. You talked about some construction delays. We're going to continue to see those. Realistically, the completion number is probably somewhere at 250 to 260,000 units, so pretty much right in line with that 2014 level.
So looking into 2015, our forecast baseline right now, we're still fine-tuning these at the metro level. Our baseline forecast for the U.S. is that demand remains very strong, but it's likely to fall marginally short of oncoming supply. Now, the main driver in the demand forecast, obviously, is the economy. Job growth is widely forecasted to gain some more steam in the year ahead, and a decent portion of those jobs are likely headed to relatively high-paying industries that will provide some of the income growth that is needed to sustain rent growth in even these high rents we're seeing in new apartment communities. On the other hand, some of the leasing success to date and some of the new projects they've been completing in the last year to year and a half or so, some of that is traced to a lot of pent-up demand for new apartment supply. Remember, we're coming off a period, coming out of the recession initially, 2010, 2011, 2012, where we hit historical lows in new supply, and at the same time we had big demographic wave, a lot of growth in 20-somethings. So a lot of pent-up demand for new apartment supply. That was a big factor in 2014. How much of that is left in 2015 is still to be, we'll see, but likely that's going to contribute to slowed lease-up velocity over the next year. So our expected occupancy shift is still rather slight because we do expect demand to be strong. We see occupancy coming down about 30 to 40 basis points, but that would keep occupancy at the essentially full mark, right around 95%, give or take a tick or two.
And strong occupancy, I think that's pretty much a given as we look into the next year. The rent growth number actually is a little bit more of a question mark. And I think that our forecast, given we just told you that 2014, the number was 4.7%, I think our expectation is a little bit lower than some might expect. We're calling for rent growth in the 3.5% to 4% range. A couple of factors come into play there. You mentioned maybe exhausting some of that pent-up demand that's been in the marketplace. Top-tier product coming online, particularly in the urban core. We think that's going to be a competitive leasing environment that could certainly slow down the rent growth in those units. That big middle market segment, you have to be a little bit concerned about affordability. And then I'm going to throw in one more influence, and really we haven't heard people talking about this one yet, but I think it could be a meaningful factor that sort of determines whether we're going to end up toward that low end of the range or the high end of the range that we're expecting, and that's unit turnover. And we have been in this situation where turnover is at very low levels, but Jay, you were talking about the accelerating employment growth. We think the wage growth numbers will kick up a little bit stronger. That tends to lead to some mobility.
Right, as people get new and higher paying jobs, they tend to move closer to their jobs. They might be moving from one part of a metro to another. Furthermore, when the economy is doing well, you tend to see a pickup in both marriages and divorces. That plays a role in household composition, as well as the fact that the birth rate goes up when the economy is doing well, and that could play a role in household formation and composition as well. People may be moving from one type of housing to another. And that ties obviously to the home sale market, and there's some expectation that the home sale market continues to improve in 2015, and it probably does, but we don't think it's going to have the negative impact on the apartment sector as some expect to see. We're going to continue to see lots of young adults entering their early 20s who will be looking for a housing option for the first time. And for most of them, the first thing they're going to look for is an apartment at this life stage.
And we don't want to oversell that mobility story. And it's not like the switch is going to be flipped overnight. But in fact, we are well overdue for people to start moving around a little bit more than they have over the past few years. And when that starts to happen, I do think it means that operators cool off the rent growth pace just a little bit.
And there's a lot more to talk about what's going on in the U.S. apartment market, and as well as all the individual metro results across the country. In the next episode, we're going to look at an always popular feature, the rent growth leaderboard for 2014. So until then, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics from MPF Research, and Happy New Year.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.